All right, so chapter 7 is kind of like a, I don't know, odd chapter. Um, we're kind of covering some important but kind of peripheral topics, I would say. Um, so what is this chapter about? Really, it's about this topic of internal controls. Okay, I think that's maybe what the title of the whole thing is. Um, and really, it's like, yes, we're going to talk about what internal controls are and kind of what their role is in accounting systems. Um, but really, there's like these two kind of periphery topics: petty cash transactions, and also bank reconciliations. Okay, so these two are probably like the two like main skills you can say: petty cash and bank reconciliation. So I think we're going to try to spend most of the time doing those two, especially the bank reconciliation. Um, this is also an important one, debit and credit card sales. So that's kind of a periphery topic. And then we'll talk about one of the financial ratios, the cash ratio. Okay. But really, the main learning of this chapter, I would say, is really number one, the bank reconciliation. We're going to probably spend most of Wednesday doing that. So I would not miss Wednesday. Okay. I think we're going to get all the practice with the hardest part of this chapter then. Um, and then, yeah, so I think that's like the main thing. And then, just some other miscellaneous stuff. Okay, so it should be in the grand scheme of the class now, it's like not too bad of a chapter, I would say. The bank reconciliation is a little tricky, but if you're here and you kind of pay attention, um, I think you'll hopefully understand it. We're going to do at least a couple of practice problems. Okay. Um, so we've talked about this, so maybe we'll have a little discussion here. What are some of the types of fraud, scams, mistakes that a business needs to protect against? What like we've mentioned several of these just through the course of the different accounting topics we covered, but name some that you remember. Yeah, Scott. Embezzlement, okay. Embezzlement, okay. What does that mean? It's okay. It's related to someone stealing the company's funds, right? You're kind of taking the company's assets and siphoning them off for you individually. Okay, yeah. So that could be done by an employee. Embezzlement usually implies an insider doing this. Okay, yeah. Did you have is it Rin? Rin, right? Yeah. Was that theft? Yeah. So we talked about theft. Uh, by your customers or third parties, but also theft from employees, which is kind of covered under this embezzlement thing. What else? Any other ideas? Yeah, sure. Yeah, exactly. Yeah, so that's an example of someone who had access to the accounting system, uh, manipulating it to, basically pay himself from company's money. So yeah, that's like definitely a good detailed like what someone did, but that would count as embezzlement. It's like taking of the company's assets. Yeah, so misstatement. So we talked about shrinkage, for example, right? That could be from mistakes in the accounting system. It could be from theft, damage. So that was like could be a mistake. It could be a fraud or a scam. Um, so yeah, we talked about a lot of these. Uh, theft, employees scamming, right? We talked about. I think we mentioned how you could mess with the timesheets. There's different ways your employees could scam you. Your company has assets, equipment that could be misplaced or stolen. Um, We talked a lot about inventory, right? What is in inventory? What is the value of the inventory? So these are areas of kind of sensitivity where mistakes or fraud could happen. And then credit sales. Okay, this is one maybe um, we touched on, where if you're selling things and extending credit, meaning the customer is not paying you the cash right away, right? That's if you're it's essentially giving loans, right? So if you're giving loans to customers who are not going to pay you, or making sales to fake customers, maybe that's like a fraud or a scam. That's an area of fraud, or mistake or loss for your business. Okay, so obviously a business needs to do stuff to prevent all this. We agree? Like this is all bad for us, right? If there even mistakes, which are potentially not anyone's like intentional misdoing, but we want to prevent mistakes and misstatements. Okay, so a business is going to implement certain things, which we call internal controls, to basically protect themselves and their business against this. Okay, so uh, these are systems that are put into place, and they're related to the operations of the business. And again, they're really to protect against fraud, embezzlement, and scams. So this is external parties, embezzlement and scams from internal parties, such as employees, executives. You want to prevent waste and loss. So again, even if there's no scam involved, like if you're not keeping track of the company's laptops, for example, they just get lost. You have to keep buying more. So you want to control waste and loss. That's also an expense for your business. Okay, so you want to have systems in place to manage that. And then, of course, mistakes and errors, because that can be costly for your business too. So, what do they promote? You want to make sure your assets are safeguarded. Okay, so you want to make sure that your physical assets are protected. You want to make sure your financial assets, like your cash in your bank account, can't get easily stolen or misplaced or unaccounted for. Um, you want to promote operational efficiencies. This kind of is related to these two. So these two are related. Waste and loss are going to obviously make your business less efficient. And same thing with misstatement or errors. And of course, accuracy. Okay, so when in the end, you want to be able to not only report accurate information to your third parties that are reading your financial statements, but also if you're the manager of a business, you want to have an accurate sense of what's happening in your business. And if you have a bunch of inaccuracies and misstatements and errors, you're not going to even have a good sense of what's going on in your business. Okay, so um, you're going to have to set up things within your business to uh, kind of control for all this stuff. Okay, so I think it's kind of straightforward, common sense. There is kind of a framework that is commonly used by businesses, like large businesses, called the COSO internal control framework. Okay, so let's just talk about what the different um, elements are. And it spells crime, CRIME. So it's kind of easy to remember. So the C stands for control procedures. So these are the things that are actually implemented on the ground to um, like their business processes. For example, um, if you have your inventory coming into your warehouse, you will have a system in place where the employee who's there at the warehouse will have some documentation, like a purchase order. They're then uh, instructed and trained to look through what's arrived, check it against the receiving kind of the purchase order. They're going to write down exactly what was there, what was received, a manager signing off. So there's some kind of supervision. All of these things are procedures, right? Or like if you're tracking your employees' time cards, okay, there will be a procedure where you have to clock in, either using a thumbprint or some way to clock in and clock out. And the way that information is then given to the accountants. All these procedures are actually put into place to kind of within your operations, and the better your controls are, the more thorough they are, the harder it will be for loss, theft, fraud, all that stuff to happen. But this next one is related to kind of, you don't have infinite resources and like manpower, money to put crazy amounts of control procedures into everything. Okay, so you have to figure out what parts of your business are actually vulnerable, and that's what this risk assessment is. You're going to look through all the different parts of your operations and determine where the risk for fraud, misstatement, mistakes, all that stuff happens. Okay, so that's actually an important part of prioritizing where you're going to spend more time with putting in more strict or less strict control procedures. I is its own thing. Information systems now in the modern era, everything is computerized. Like even small businesses are totally reliant on kind of computers and computing to manage their business. So having internal controls on just the information system is really important. Like for example, we all use like let's say you're entering information into some website and you put in something and it like doesn't allow you to submit it and it gives you an error that says, hey, this is not formatted right, or hey, you forgot this. That's an example of an information system control. It's not allowing you to kind of input information into the information system without certain checks. Okay, so because again, information systems are so critical to a business's operations, it's like its own category of control procedures. Okay, so now you'll start noticing it. Like whenever you use websites, these are like widely implemented, and even like how you shop online and at work, if you use a computer system, it's gonna throw errors and like not let you do stuff unless it's formatted correctly, it's complete. Maybe there's gonna be some level of sign off. Like if you submit something, it has to get approved by someone else. These are all happening within the information system. M, so you can set everything up, but if there's no one or no way that this entire thing is monitored, then it can maybe be failing in ways and not really be working as intended. So you have to have some ongoing monitoring system in place. And then E stands for environment. And so this kind of goes to like the culture of the institution. Okay, there are some companies that maybe set up stuff just for like window dressing, and they don't really care about following it. While some businesses are really uh, emphasizing in their culture of following procedures and kind of managing risk. Okay, so this environmental factor is actually really. It's like we may have laws, like you can even think about this, like if you live in a city, right? There's laws against certain things, but if there's no enforcement of it, then like there's no point in even having the law, right? So the environment of like how seriously internal controls and like risk management are, that's going to vary between businesses. Okay, so of course, if you want to do a good job and manage your risk well, you're going to have a culture in your company that emphasizes that. Okay, so making sure that environment, that kind of tone of management is there is also important, just as important as like all this technical stuff. Okay, and then the auditors are here to kind of ensure this whole thing is working correctly too. Okay, and there's external and internal auditors. Um, within a company, there will be like usually for large businesses, people that work for the company that are in charge of auditing and making sure things are working correctly and there's no fraud and like whatever. They're going to be investigating to make sure things are working within the parameters of this kind of framework. uh, they have a special privilege of reporting directly to the board of directors. Okay, so we talked about the hierarchy of in a corporation. The shareholders are at the top. They're the owners of the business. They appoint a board of directors, and then the board of directors, they're like looking over the CEO. So the CEO of the company has a boss too. It's the board of directors. The board of directors have a boss who are the shareholders, right? So the internal auditors usually don't report to the CEO. Okay, they're directly liable to the board of directors. Okay, because the CEO may be the one committing the fraud, right? So it wouldn't make sense for the internal auditors to report to them. They're going to report directly to the shareholders. I mean, not directly, but to the shareholders' representatives. Okay, because they're looking out really for the shareholder. The CEO is supposed to be, but oftentimes CEOs also have conflicts of interest. They want to kind of, they have their own self-interests that are in conflict with the company. Okay, so they could also be the root of some problems. External auditors, they have their own conflicts though, because usually they're paid by the company. So if the company as a whole is doing something wrong, that could be a problem too, which has been a problem in the past with auditors. Um, but now there's some rules in place to help mitigate that. But really, the job of the external auditor is to be a third party that has no skin in the game, that's able to fairly report to the public what's going on with the company. That's the theoretical kind of role of the external auditor. Okay. Um, this is all set up. I don't know. This is like kind of historical information. This COSO organization uh, is a result of some government action that happened in the 1980s. Um, and there, I guess there's probably some frauds that were happening at the time. Usually, all these things are in response to some scandals. Okay, so the whatever was happening in 1985 in the financial markets probably caused the government to take some action, and they came up with this framework. Okay, and now this organization COSO is still kind of in charge of you know making all the details of this framework that companies are supposed to implement. Okay. Also related, another law that was passed in response to some financial scandals was the Sarbanes-Oxley Act. What was happening in 2001? Many of you were probably either not born or anyone know what was happening in the late 90s and then it kind of ended in 2001. Yeah, the dot-com bubble. Okay, so that was one big kind of hit to the financial markets where you had this huge run up in stocks, and particularly in stocks related to like web, like the internet, because the internet was like really new at that era. But there were really two main like accounting frauds that happened. Enron was a big one, and WorldCom. WorldCom was actually, you could consider a tech stock. They were involved with like fiber optics and like laying kind of the infrastructure for the internet. Enron was like an energy company, so it was kind of unrelated. But they were really two really big financial scandals where the companies were like kind of misreporting, or like they were doing very aggressive stuff. And I think we talked about Enron a little bit in a previous lecture. Um, but in response to that, because so many investors lost money on these scandals, the government, again, instead of preventing things, they're just kind of fixing the last problem. They passed this law. Um, and so the key parts of it are executive accountability. So that means that the CEO and the CFO, like basically whoever is signing the financial statements every quarter for the company, they could be criminally liable if there's any like serious fraud. Okay, so now there's like skin in the game, right? The CEO and CFO, they could go to jail if things are like very wrong in the financial statement. So this is trying to create an incentive for companies not to like be very uh, overly aggressive or like clearly or fraudulent in their reporting. Okay, um, because you could argue that Enron was within the bounds of the law, but they're just so egregiously aggressive in what they were doing that it rolled into being fraudulent. Okay, so this law was meant to make the executives think twice about being overly aggressive in how they presented their financials because they could go to jail. And there have been prosecutions of CEOs and CFOs under this. Okay, so I don't know how well it's worked because there haven't been like a ton, but there have been some. Um, Another thing is the internal controls. Now the auditors have to not only check the financial statements, they have to check and make sure the internal controls are sufficient within the business. Okay, because you could argue that if their internal controls are not good, then the whatever is coming into the accounting system is also going to be wrong. It's like garbage in, garbage out. So Sarbanes-Oxley, it forced the auditors not just to look at like the ending balances of the accounts and like kind of look at the accounting system. Just they have to look at, are they doing a good job with receiving? Are they doing a good job with all the stuff, right? Like how good are their systems set up to make sure what's going into the accounting system is correct? Okay, so this was like a big jobs program for the CPA firms because it vastly expanded the scope of the audit that they have to do every year. Okay, so this created a lot of work for CPA firms and a lot of fee income for them. So, I'm sure that they were happy about that. But it's like an extra expense for the company, extra headache to deal with. Um, the auditors also became a little more scrutinized because you can argue that Enron and WorldCom, these financial scandals, they were enabled by their auditor because really the auditor has to sign off and say whatever they were doing is okay in this like opinion letter that they give every year. Okay, so the fact that the auditors allowed these things to happen also was an indictment to them because their whole job, the why they exist, is to prevent these types of things from happening. So if they screwed that up, the question is why. And one big part of it is that the auditing firms who are paid by the companies, they have multiple business lines because not only were they doing financial audits, they were doing like business consulting. So they didn't want to make the company unhappy, right? If you don't want to make the company unhappy, then you're just going to kind of give them what they want, right? So that's why in this act they try to separate the audit kind of function from all the other business consulting that these firms were doing. And they also made them rotate. They had to rotate partners. So if a audit partner had been working on some company for some time, they had to switch to someone else so that they didn't become like homies with the executives. Because you got to have some adversariality. You got to have the CPA be adversarial to the company. Their job is to regulate, is to like make sure they're doing a good job for the benefit of the public, right? So in order for that to be achieved, you have to like they can't be homies with each other. They got to be a little adversarial and not adversarial in the sense of like hating on each other, but like they can't be so close as to allowing the business to influence the judgment of the audit partner, okay, or the whoever whatever CPAs are in charge of the audit. Okay, so there are some rules that were put into place for that. Um, so what has been the impact? So again, it's been like whatever, over 20 years that this law has been in place. It has boosted the cost of compliance. Okay, so if you're a public company and you have to adhere to this, you're spending a lot more money than you were before on CPAs. Okay, um, so that's one thing that, of course, not only affects the business, they have to hire people to kind of deal with the extra burden of the compliance. It's just an extra cost to the shareholders. Okay, so the shareholders are paying for this. Um, it could be argued, and it's hard to tell these things, right? It's hard to tell whether it has like made an impact because you'd have to have two parallel universes where you have one without this act and one with to see what the difference is, right? So you can still say, hey, we still have fraud and there's still financial scandals, but would it have been more without this? I don't think it's really possible to say, okay, definitively. This is all opinion, okay? So those who are regulators will say, yes, it has. It creates the right incentives, okay? While some might argue like, no, we still have big scandals and it doesn't work, okay? But the truth is probably somewhere in between. It's probably a little bit of both. Okay. Any questions on this? No? Okay. Um, So what are some of the internal controls? So now we're kind of getting to this first part, these control procedures. Okay, what are they? What are the different facets? Okay, so the first one you can argue is personnel. Okay, so you want like really it's fraud is committed by people, right? So you have to have various controls in place to figure out who is working for you and even managing them and training them and making sure that you're controlling for the people. Okay, so you want to screen for competent, reliable, and ethical people. So how do employers do that? Maybe some of you had to comply with this internal control procedure to make sure that you're an ethical actor. What do businesses do when they're like screening for applicants? Sometimes, yeah, background checks, right? The background check is exactly this internal control procedure to make sure that you're hiring someone that's trustworthy. Okay, they don't have to do that, right? There's no like law from above that says you have to do background checks. Okay, I have a friend that works for the state of California, and it's for like the licensing board for like working with senior citizens. And his job is if someone is a felon and they apply for one of those jobs, they can still apply, but he will then look at the charges and look at the rap sheet and like look at all the stuff to see if they are approved. And some of them do, they committed a crime a long time ago and they do make it through. But a lot of them are like, if they had theft, multiple theft, like kind of charges, and they'll get denied. Because why? Why would you not want someone that's like a thief to work with old people? Yeah, they're gonna rob them, right? Old people are vulnerable and they're like very easy to steal from, or easier, you could say. Okay, especially if they're like in a nursing home or something. That's what these jobs are. Okay, so um, a lot of this is done on the front end to screen people. Pay, right? Do you think you're going to attract higher quality and more ethical, more conscientious workers by lower or higher pay? Higher pay, right? So you can pay, the pay is going to be oftentimes correlated to this. Just knowing something about India, because my family is from there, one of the huge justifications for like the amount of corruption and bribery that happens there is because the civil servants are not paid well. Okay, so they one argument, and I don't quite agree with this, is that they're justified by in taking bribes because the government doesn't pay them a lot. Now, yeah, that's feasible, but then just go get another job that's higher paying. Like I would argue, I think in the end it's like an individual's choice to act ethically or not. But that is a factor. You could argue in America, the cops are very well paid, and we don't really have bribery as a big problem here, like it is in other places in the world. It could be that because the cops are paid really well. Okay, so it is a factor. It's a factor. It's not maybe the factor, but it is one. Um, Training programs, right? So again, this is going to probably be part of that environment factor, where if you're really bringing in employees and training them and introducing them to a culture of ethical conduct within the business, and that's really emphasized. It's like humans are quite programmable. Okay, we kind of fit into the culture of wherever we are. Um, so, like this is the whole theory of in New York City, the subways, they had graffiti all over them, and to like reduce crime, whenever there was graffiti, they're just painted immediately right away. And over time, it was argued that um, people seeing things that were orderly, that just like that kind of primes your mind to like not create disorder. Okay, so there's probably a good amount of truth to that, where you're gonna adhere to kind of the culture of where you're in. So if there's a lot of disorder and chaos and dishonesty, most people, uh, and I hope all of you will have an independent sense of like honor and trustworthiness and stuff, independent of what other people are doing. That's the ideal. But society, the unfortunate truth is that like when you're in a place where integrity and acting like a high trust society, you're gonna also conform to that. But when you're in a low trust environment, you're gonna just conform to that too. Okay. So as a business, you want to create like a high trust environment, ideally. Okay, and then rotating time off. Okay, this is kind of like a subtle one. When I worked in investment banking, I had to every year take a mandatory 2 weeks in a row off. Why do you think they did that? And I was like, kind of dealing with like trading books, like the bond trading books. Why do you think they forced me to leave for 2 weeks? Any ideas? Yeah. Okay.
While you're out, someone will gonna have to replace you and like figure out
Exactly.
continue what you did.
Exactly.
Mistakes, fraud.
Exactly.
It's much easier.
Yes. Yes. So if someone has to do your job and you're like doing a bunch of fraud and like having to do a bunch of stuff to perpetuate that fraud, when you're gone, you're going to have another set of eyes on it. Okay. So, this is a procedure. Again, there's not some rule from above that says that, every business has to force their employees to take 2 weeks off. They had a procedure set up that was addressed specifically of undercut, like overturning fraud if there was someone doing it. Okay. So again, this is something set up by the employer. Okay, assignment of responsibilities. So you want to have each role defined and have clear responsibilities. This is not just a fraud thing, this is an efficiency thing. Okay, if you're not telling people what they're responsible for, important business processes or tasks could go undone. Okay, so it's imperative for the business to make sure that every employee knows exactly what they're accountable and responsible for. Okay, so this is just something towards efficiency, uh, you know, good business practice. Um, okay, separation of duties. So this one is more of a fraud prevention thing. Okay, so you don't want someone to control in general the cash and the accounting. Okay, you want to separate those duties. Why? Because if I was responsible both for approving or like generating purchase transactions or like purchase orders, and I had control of the money, I could just create a some fake vendor that's my own bank account and then also write the check there from the company. Okay, there's no check or balance there, right? This is kind of our government. Okay, we have checks and balances. So just like that, you want to have checks and balances within a business. And usually, like for accounting, especially, the accounting function and the cash function, disbursement and receiving of cash, that should be separated, because then those two teams have to agree with each other. Okay, they can't function independently. Okay, so even like yeah, the accounting function is separated from any custody of assets. So even like controlling the company laptops, right? If I was the accountant and I was like managing the IT, I could just take 10 of the laptops and say, oh, like write it off the books and just say like they're gone out of the accounting system and just take them home. Okay. So you want to make sure that there's a difference between the accounting system and like all the other operations. Because if you controlled both, there's a lot of easy ways you can do fraud. And I'm going to show you a video in a second of that happening. Okay, audits. Of course, you want someone checking to make sure everything is working correctly. So that's what the function of an audit is. Documentation. So if you don't have good like records of things happening, there's also uh, a lot of room for fraud. So you want to make sure that every transaction has some kind of paper trail, and it's not necessarily physical paper now. It's going to be somewhere in your information system. But you want to make sure that things are well documented, and like someone could go through the documentation and kind of recreate your books. If you're doing a lot of stuff ad hoc and like, whatever, without paper trail, then it's going to be hard for even an auditor to make sure things are happening correctly. So you want to make sure transactions are backed up with some document, organized and numbered. Okay, so if you have unnumbered invoices or receipts, it's easy for someone to just lose one, and like you'll never know, and that could be losing it unintentionally or to commit fraud, right? So um, and we'll see that when we talk about petty cash transactions. You'll see where that numbering system, an example of why it's useful. Okay, and then this is a big one. Okay, cybersecurity. This is like kind of a modern problem, but this is a big, huge spend for businesses now to make sure that their data and their networks are not hackable. Okay, and so you want to make sure encryption happens. There's firewalls, um, and so this is actually a big risk. Probably a lot of our data is out there on the internet because of data breaches and stuff, like your address and your credit card information, maybe probably your social security number is probably floating around on the internet because there's some company that had it and they got hacked. Okay, so um, this is like it's a pretty big deal. I was reading, does anyone know what the most used operating system is in the world for all computers? Nope. That's for personal computers, you could argue. Yes. Yeah, Linux. Okay. Linux is the most used operating system in the world. Um, it is open source, and I was watching this documentary about how there was probably a state actor that figured out a way to get a Trojan horse, like basically a back door into. There's like a part of Linux that encrypts uh, server communication, and it's dependent on a bunch of other different parts of like kind of this open source universe. And so there was some small part of it that no one was watching that was basically like impregnated with a backdoor, meaning had that code gotten into kind of the newest update of this operating system, and it was kind of determined as a state actor. Okay, like some government had created this fake person, and they were kind of like they had for years been kind of developing uh, this persona in this open source like software community, and had that little piece of code gotten in, they would have had access to every server in the pretty much every important server in the world, like our energy grid. All this stuff is running on servers that are running Linux. Okay, so uh, it got caught like I don't know, like a couple of weeks before the update was going to happen, just randomly. Okay, so it's a big deal. Like it's a really big vulnerability now for our whole society, and the companies spend a lot. But there's probably some other hackers now. There's probably other hacks, and it could already be there that there's a backdoor somewhere, which is pretty scary. Um, so But our government probably has backdoors too. It's like we're not just the victim here. We're probably we're on the offense in this war too. So maybe it's like the nuclear arms race. Like no one wants to act because everyone knows the other country will retaliate. But anyways, for a company, this is a big part of their spend. Okay, so I have a fun little video. I think it's sad fun. The guy has the same last name as me that perpetuated this fraud. I'm not related, so don't hate. But yeah, I think this. So he worked for the Jacksonville Jaguars. He's like in the finance department, and he just basically used their lack of internal controls to like totally run a scam. Okay, so let's like watch this little video. You can see this in real life. What happens when things go
Drinking warm
wrong?
water before bed improves eyesight almost overnight. Thousands of people are already doing this every.
A downfall from luxury living, from flying on a private jet to a Jaguars game, to lounging on a boat in Miami for an international racing event. This former Jaguars employee who embezzled millions from the team because he said he has a gambling addiction is preparing to head to prison. He did not respond when News4Jax reporter Ann Maxwell tried to question him moments after he heard his sentence.
We understand the gambling addiction argument, but what about the country club membership, the trips?
31-year-old Amit Patel faced a judge today who told him he will spend more than 6 years in federal prison for his crimes.
He spent most of the money he stole from the Jaguars on online sports gambling, but also on personal expenses such as lavish vacations, private jets, spa treatments, concerts, sporting events, a $95,000 watch, and more. News4Jax reporter Ann Maxwell was in the courtroom where Patel apologized.
We understand the gambling addiction argument, but what about the country club membership, the trips? Is there an explanation for that?
Amit Patel was silent, leaving federal court after being sentenced to 6.5 years in prison for stealing more than $22 million from his former employer.
Do you feel like that sentence is fair?
Based on the facts of the case, federal prosecutor Michael Cooligan had been arguing for a 7-year sentence.
I think it was a fair and just outcome.
Prosecutors said Patel used his position as a financial planning and analysis manager for the Jacksonville Jaguars to spend millions on the team's virtual credit card for his personal use, creating phony statements to cover it up. A government analysis found Patel spent more than $21 million of the Jags' money on online gambling sites FanDuel and DraftKings, and funneling more than $5 million to his personal accounts, spending nearly $79,000 of embezzled money to travel on private jets, $200,000 on golf memorabilia, $78,000 on a country club membership, $140,000 on eBay, $25,000 at restaurants and bars, and $234,000 on his home and vehicles. Patel's attorney said his client suffers addictions to gambling, alcohol, and drugs, but has worked hard to turn his life around, getting sober, going to meetings, and even starting a Gamblers Anonymous chapter in Jacksonville Beach. Patel told the court today in front of friends and family who packed the courtroom to support him he was sickened with shame, saying he can never fully convey how sorry he is to those he hurt. He said his sobriety has given him clarity, and he is committed to using his story to help others who are struggling.
The court also ordered Patel to pay back more than $21 million in restitution, making payments of $250 a month once he's out of prison. He has the opportunity to appeal this sentence and 90 days to turn himself in. Patel's attorney suggested in court today his client was spending so much money on stuff so he could resell it to keep gambling. Meanwhile, the government argued Patel spent money to live a life of luxury. I mean, you see some of the photos here. These were entered into evidence. Prosecutors pointed to how Patel spent about $279,000 on travel, making trips to Miami, Sea Island, London, and more. Stacey?
Thank you, Ann. And if you struggle with a gambling addiction, there is help. There's a hotline you can call for confidential help. It's 1-800-662-4357. We have also posted this number on our website.
If you eat butter daily, this is what happens to your
Okay, so we saw a big failure in the what's it called? In the internal controls. So what were the failures? Yeah.
Clearly, he was the only one like doing financial statements.
Exactly.
Nobody caught it.
Exactly. So he had control of the cash, meaning the credit cards, right? He had full access to those cards and the accounting books, right? He was somehow categorizing that spend as company expenses, right? So there was no separation of duties. there was no oversight, right? So all that spend was like there's no review of it. So yeah, this is like a total failure. And the Jacksonville Jaguars is like an NFL football team. It's like not some small company. And so this is why it's important. There, and he spent. I still can't believe that of that. It's like the largest spend was like on gambling. Like that just I just don't understand that. Like I don't. I guess I don't know a gambling addict intimately, so I just don't understand how you could be that dumb. But um, yeah, I don't know. I heard that the thrill of losing the money is actually bigger. I don't know if this is true. Again, I don't understand that, but yeah, it's not his money. But I think from what I've like read or heard in I don't know where podcast or something, it's like you lose the money and then that down, you really like you want to be in that down state because when you start winning again, it feels so good. So yeah, again, it's like it's a really psychological disorder if you ask me. But anyways, yeah. So but yeah, it was able to get so far because of all these lapses. So yeah, it's his fault for sure, but it's also the Jaguars' fault for you know losing their money. The owner's money. So and yeah, I'm sure if we looked, we could find many stories like this where there's a failure in internal controls. Yeah. Yeah, it's a loss. I mean, maybe they could try to claw it back, but FanDuel is like we just it's not, they will also argue that the winnings went to the someone took the other side of that bet. So they're like, why are we're not liable. So yeah, it's probably the Jaguars just took the loss. Yeah, I think it said it was years. He's doing it for years. Yeah, I don't know. That's how he got caught. Yeah, we'd have to like read the case and like figure it out. Yeah. 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 Exactly. So what should have happened? Well, for you, I would say the number one control is that there's a credit limit. You cannot spend $20 million because there's a limit on the card, right? So that's the first control. Secondly, you could go spend all that stuff, but then you're gonna your boss is gonna see the statement, right? And he's gonna ask you what was all this for. You'll have to oftentimes if you're using a company card for a trip, you'll have to submit an expense report that says exactly what you spent. If for like larger businesses, maybe if it's a small business, he didn't make you do that. But usually, if you're like a consultant for McKinsey, when you're out on your trip, you're gonna submit whatever you spent stuff on, and so it has to reconcile. Yeah, of course. Well, let's say that it was like over 5 years, and he's spending 5 million a year. What is the total spend on all the cards for the Jacksonville Jaguars? It's probably in the tens or hundreds of millions. So maybe he was able to bury it within all the other actual expenses. Um, but still, it sounds like a lot. $20 million is a lot. Even it's hard to imagine that like he was able. Yeah, it's hard to imagine how incompetent the accounting department was to allow this to happen. Yeah.
We know only of those who fail.
Of course, yes.
And we need them.
Definitely, yes. I mean, for sure. Yeah, I agree with that. Yeah, there's so many that are still going on. Yeah, I agree. Okay, any other questions on this? Comments? No? Okay. Okay, so now let's ask another question. Okay? Common sense. Should you hire a security guard to protect a safe that has $1,000 of cash in it at any given time? Who thinks it's a smart idea? Who thinks it's a dumb idea? And why? Who wants to offer their reason why? Exactly. Okay. This is, again, goes to the risk analysis, risk assessment, right? In this case, you would say, yes, there's a risk here, right? Someone could rob that safe, whatever. But when you did a risk assessment, you'd be like, well, the exposure is not that much, right? If it was $1 million or $10 million in the safe, yeah, then the risk assessment is going to change, right? But for this case, it's not going to be worth it to put in a control procedure or like some control because it's not that much money. And the cost of implementing the procedure is going to be more than what you're going to get as a benefit. Okay, so again, this is to the second point. How should you think about cost benefit? Okay, really, you have to do a risk assessment. This is the point of the risk assessment: is to see what the exposures are, and in order to do a cost benefit, you need to know what the benefit is. Okay, the costs are easy. We can just go, call some security companies and see how much it costs to hire a security guard. But we also need to determine what the benefit is. Sometimes I guess the costs are harder, like to implement a new information system or something. Like the state of California, they paid Accenture, which is like this IT consulting business. I think it was like in the hundreds of millions of dollars to like come up with a plan to modernize its computer systems, and like it's like nothing ever happened. So they just basically paid that company to come up with a plan. They probably did, but then it just went nowhere. Okay, because for whatever reason it was too costly to implement the plan. Our government is not very good at executing things, which is probably the case. But yeah, it could be also not easy to say how easy it is to implement a procedure if it's a very big one. Okay, what about this? Are internal controls 100% effective? And what ways can it be broken? So who has an opinion on this? Any opinions? Can you ever create a foolproof system of internal controls? No. Okay, I agree with that. Mohammed, what are you going to say? Exactly. You could argue all internal controls can be beat, especially through collusion. Okay, so if you have multiple people in a company colluding together, then you can probably beat most control systems. Okay, so yes, they're never going to be 100% effective. So you're gonna have to take. There's always risk. Okay, but you want to minimize that and make it hard for people to collude. Okay. I'm not going to dwell on this too much. Um, Basically, this is like a schematic for cash payments. Okay, so you can see here, uh, you would have a system of procedures and checks in place. And this is in the case where you're going to pay someone money for something. Okay, so just to step through this, let's say you have some, like your research department needs a new supercomputer. Okay, that research department is going to be the requesting department. Okay, they're going to submit a purchase requisition. They're going to be like, okay, we need to buy this supercomputer. This is going to be some manager. Okay, some person in management who's been designated to decide what is kind of the budget, what is the proper allocation of resources of the company. And they're going to either say no, in which case this purchase request dies, or yes. If yes, it goes to this next one. So now we have approval. Okay, purchasing is now going to create a purchase order. This purchase order is going to get approved. Okay, if it's yes, approved. it's going to go to the vendor. Okay, so the vendor is, the Cray computers, like the supercomputer maker. Okay, so they're going to get a purchase order that says that we want to order a supercomputer. Okay, they're going to send the item, okay, to our receiving department. So this is the next thing. So the goods arrive. Your person the at the warehouse is going to count and make sure it's the right thing, and they're going to create a receiving report. Okay, and so now all three of these things are going to come to the accounts payable department. You're going to have your purchase order, which says what you wanted. You can have the receiving order that says what arrived, and then you're going to have an invoice that says what is the vendor charging me for. Okay, so all three of these things should be the same. What you wanted is what you received is what you're being charged for. Okay, so once these are all matched and accurate, if there's no, then you have to figure out what went wrong, obviously. If it's yes, then you're ready to make the payment. Okay, so then you have a payment voucher that's created. This is going to be approved, right? So now someone is going to scrutinize. They're going to say, hey, let me see this purchase order. They're going to review all this documentation, make sure this is a legitimate purchase. Okay, so if it is yes, then the check or the EFT payment is going to be initiated. And again, this is in a different department, right? So accounts payable is accounting. The treasury department is the person who's actually handling the cash. Okay, so this is going to be another final review, right? Another person is going to scrutinize all this to make sure that it is legit before issuing the payment. So if it is, then they're going to release the payment and then the vendor will get it. This recording of the payment in the journal will then go back to this accounting department. Okay, so all this is implemented in the information system, right? Now it's like maybe like 50 years ago, it was like all with papers and purchase orders and it was all like paper stuff. Now this is all in some computer system. But the general documentation and the flow of things is the same. Purchase order, receiving order, invoice. It's all going to be the same, but it's just going to be in electronic format. Okay. Okay. Any questions on this? Everyone kind of see the flow of how procedures are kind of implemented and why? Yeah.
So on each step, accounts payable and treasurer have to communicate because treasurer should not write anything in the books.
Exactly. Yeah. So they're going to see the information. Yeah. So there's some risk that the accounting department is just going to show treasury some doctored or fraudulent things, but there is going to be some scrutiny, So the treasury department should be acting independently, and if they're smart and they're like observant, they'll be able to see if there's fishy things going on. That's the idea. But of course, no procedure, internal control procedure is perfect. You can have very clever fraudsters that are going to fool the Treasury Department too. Could be. But yeah, you would set up some way that the Treasury Department could go to the accounting system, see if anything was altered. There's like some log of any changes. So they should be able to do an audit themselves to make sure if they were suspicious of something. You would think that the information system is set up to allow that.
Canceling voucher and documents and saying it's paid on the treasury side means that it's supposed to be reflected in the.
Yeah, so they will, when they issue payment, they're going to say, this voucher that I've received from accounting, I'll stamp it because I'm the treasurer. I know the payment has gone out, right?
Stamped document and I go there 40 books to report.
Exactly, the cash. Yes. Yes. Okay, and again, even this, the purchase order to the vendor and the vendor sending an invoice, now there's like, there's electronic kind of exchanges between customers and vendors that make all this easy too. So it's not like you have to mail this to your vendor. Usually there's going to be some data connection between you and a vendor that you use a lot. That's going to facilitate that whole process too. Okay, and then there's a similar thing for cash receipts. So whenever you receive cash, it's going to be the same. I don't think it's worth going through. You can look at this on your own. I think the point I'm just trying to emphasize by showing you this is that there is a flow and a systems of checks and balances in these types of operations that happen in a company. Okay, and they kind of follow the same. There's some principles, right? There's usually some approval that's necessary. There's usually multiple layers of scrutiny. There's usually some reconciliation between different documents to make sure everything matches. So these principles are going to exist throughout these different kind of flow diagrams for these types of internal controls. Okay, makes sense? Okay. Okay, so let's do a problem now. This is kind of like you can put on your hat as like a con artist and think about internal controls from that perspective of, hey, if I were trying to defraud, because now that, they have these these ethical hackers. Does anyone know about this? It's like, if you're like skilled in computer hacking, you work for a cybersecurity company and you try to hack into a system to show where the vulnerabilities are, right? And then you're going to help the company to patch those up. Okay, so you can think of this exercise like that, where you're going to be given some situations and you got to think about what controls were kind of like not in place, and think about what the fraud risk is. Okay, so this is the first one, 7-25. You're given a bunch of scenarios here, and you're going to have to basically describe what the internal control weakness is, identify what possible problem it could cause, and propose a solution. Okay, so this is like a little real world practice in internal control situations. Okay, so why don't you start reading through these, thinking about what the issues are, and we can talk about it as a class. Okay, so the first one, Creative Solutions Applications develops custom programs for customers specifications. Recently, development of a new program stopped while the programmers redesigned an accounting system. The accountants of the company could have performed this task. So what is the violation here? What is the internal control? Not necessarily for fraud, but for something else. What do you think? What is this company not doing well? Almost. The accountants could have done it, but they didn't. Yeah. So. Almost. Because yeah. Assignment of responsibilities, exactly. The software developers, their job is to earn revenue for the business and make software for clients. And in order to do something that another set of employees could have done, they stopped that. They stopped their revenue generating function to do this internal project. Okay, so it could have been that if the accountants couldn't do it and they needed the software programmers to do it, then it could have been justified. But the fact that the accountants could have done it, it's just an inefficiency, right? They lost revenue generating opportunity because they just didn't have clear assignment of responsibilities. Okay, clear? Make sense to everyone? Any questions on that? No? Okay. Okay, the next one. Ken has been your trusted employee for 24 years. He performs all cash handling and accounting duties. He just purchased a new car and a new home. you wonder how he can do this, given that his salary is only $30,000 a year and it's his only source of income. What do you think? What's your separation of duties, right? He's able to do the accounting and the cash handling. Do you think that this other stuff is related about him buying a luxury car and all that? It's all circumstantial evidence, he could have family money or something. But the fact that he's doing this may raise some suspicions, but it's your business is just making a mistake by allowing the possibility of the embezzlement to happen, and that's really a violation of this separation of duties. Okay. Okay, next one. Mickey Hardwoods, a private company, falsified sales and inventory figures in order to get an important loan. The loan went through, but this borrower went bankrupt and could not repay the bank. So from the bank's perspective, what did the bank do wrong? And we have our list here. What do you think they could have done from here? Yeah, audit, right? So what would an audit have done, or potentially done, or potentially protected them against? Yeah, Chris. Yeah. So basically, what happened was this borrower presented some poorly some financial statements that were not really legit. Okay, and you would hope that if you told the borrower, hey, I can only accept audited financial statements, that a third-party auditor would have caught the fact that this information was falsified, or this borrower would have just been like, well, they're asking for something. I know my books are fake, and so I'm not even going to apply for the loan. Right? One of those two things could have happened. It could have been that they hired an auditor and like kind of conspired with them to kind of get an audited set of financial statements, but that would be much harder than the other two options. Okay, internal auditor of this company recently notified the company that its sales receipts documents were not pre-numbered. The owner replied that the company has never used receipt numbers. So which one can be improved on? Yeah, documentation. Okay. They having numbered receipts, you can tell if one is missing. You can tell, yeah, basically it's a way to see if anything's missing and your set of information is complete. Okay. Discount store makes most of their sales in cash with the remainder in credit card sales. To reduce expenses, one store manager ceases purchasing Fidelity bonds from the cashiers. Fidelity bond is like an insurance policy, you can say, that will protect against theft if one of your employees steals cash from the drawer. So this one's a little weird. It's other. Okay, it doesn't really fit within any of these other ones. But by saving the cost of this insurance product, you're exposing your business to that theft risk. But of course, this is going to be subject to our cost benefit analysis, right? Maybe there's not that much cash in the register, and maybe the Fidelity bonds are expensive. Okay, so you would have to know both those pieces of information to really say with certainty whether this was a bad decision or not. Okay. Okay. Louis Corndog keeps all cash receipts in an empty box for a week because the owner likes to go to the bank on Tuesdays when it is most convenient. So is that smart to do, to keep the cash from your business in just the box for a week? No. Why? What could happen? Yeah, it can get stolen. You can get lost. Usually cash businesses have, like, some have like multiple times a day an armored car will come and pick the cash up. Okay. So, yeah, leaving cash sitting around is a big risk. Okay. Yeah. True. 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 Or if you leave your business with the cash at a certain time every day, right? Robbing an armored vehicle is obviously like pretty risky. You know, those guys are armed, and you know, you're probably gonna be a professional bank robber if you're gonna try to pull that off. But robbing a small business owner who's just like depositing the cash themselves, that's definitely possible. Okay. Okay, so that's it. Yeah. So does everyone kind of feel comfortable with the flow of like how this works? How you should think about things? I think there's like maybe a homework question on like similar to this where you gotta do this kind of analysis. So if you have any questions, clarifications, no? Okay. All right. So okay, so petty cash. Um, again, this is kind of like a miscellaneous topic, I would say, because it doesn't really exist anymore for the most part. But what it is it's a amount of cash that's like physical cash that's sitting in your place of business that you use for immediate expenses. Okay, so what has kind of replaced this? And Chris kind of mentioned it for his work. What has replaced petty cash for the most part? Yeah. Credit cards, right? Company credit cards, right? So oftentimes there will be a company card instead of cash sitting around because it's easier to account for the card, right? It's going to have a paper trail of every transaction that's used, right? But back in the day, before credit cards were around everywhere, people would keep physical cash. Okay, and maybe some businesses still do. There's probably some use for it still. There's usually some employee that's going to keep track of it, called a custodian, and it's going to be accounted for using this impressed system, and it's basically a system that is going to track the amount that's in the petty cash account and the expenses, and make sure that that total amount is always accounted for. Okay, so we'll see how this works in a second. So what are some uses? You know, and again, a company credit card is probably more likely for all this stuff, but like cleaning supplies, if you buy flowers for someone, something happened to them, the family member died, entertaining clients, again, why you would need cash, unclear, you know, what kind of entertainment is going on. But usually that's going to be with a card now. Transportation, food for the office, tips. Maybe this one is still kind of relevant, tipping with cash. But really, all this stuff again is moved on to company credit card. Okay, but I still think that this topic is useful because it will help you think about debits and credits and like just see another way that this system is like quite robust and um, can be adapted for many different types of accounting issues. Okay, so I still think even though you'll probably never have to account for a petty cash account, that it's worth at least going through the exercise. Okay, so to set up the petty cash account, we have a journal entry. So the situation is on August 1st, beginning of the month, you want to set up $200 of petty cash. Okay, meaning you want to, out of your bank account, go to the ATM, take out $200 of cash, and have it in your office, ready to use for whatever expenses that you're going to need. Okay, so what you'll do is write a check for $200 and make it out to cash. Okay, and then that can be taken to the bank, and the bank will take the money out of your bank account, and they're going to give you the physical cash. It's just like going to the ATM. You can replace this with go to the ATM and take out $200. It's the same transaction. So what is going to happen is that you're going to debit petty cash. So this is essentially a cash account. It's the same as cash, but we're going to have like a sub account called petty cash. And this cash, you can think of like the main cash account. This is like your bank account. Okay, so what you're doing is you're removing $200 from your bank account, which is why it's credited, and you're moving it into this physical cash account. Your total amount of cash is unchanged because you're just changing the form of it from bank to physical. Okay, is everyone following this? Everyone good with this? Yes? Okay, so now you've set this up. You have the $200 of cash. Your account is been funded, okay, your petty cash account. And so now it's going to be like, you can say like sitting in a box, okay? And right now it's like the physical bills, okay? $200. So now whenever you want to use the cash, you're going to fill out this ticket, okay? And let's say we needed $50. You'd say $50. It was for buying food, okay? Debit it to office admin, okay? Office admin expense, okay? So this is going to say what account is going to be debited, essentially, okay? What expense account is going to be debited. And then who is receiving the account? So let's say I did, I'll initial, and the custodian also has to sign off. So this is like a control. I can't just go to the box and take the money out. Whoever is like the manager or whoever is going to sign off on this too. Okay, so now what is in the box after this? How much cash is in? 150. So 150 in actual physical cash. And then I have a ticket worth 50. So what is the total between the cash and the ticket? 200, right? So it's still the same. Between the physical cash and the ticket, it will always be $200, theoretically. Okay? That's what this system is trying to do. This $200 is fixed, but the allocation between your physical cash and your tickets is going to change as you use the cash up. Okay? So again, cash plus the tickets is going to always be the fund balance. Okay, not always though. There's going to be, we'll see what happens if it's not the case. Okay, so yeah, I guess this is the question. Will cash plus tickets always equal the fund balance? Who has an opinion on this? Yeah. Well, the tickets are related, as we saw here, to some expense, right? So eventually you'll see when we refill the when we refill the account, we're going to do an actual journal entry that is going to basically put this ticket into the accounting system. Because right now it's just a ticket. Our accounting system still thinks there's $200 sitting in the account, in that box, right? So we'll have to do a journal entry eventually to account for this actual expense. And we'll see that in a second. Okay, so will it always balance? I heard someone say no. Why do you think no? Yeah. Okay. In theory, it should, right? Do we agree? But what can happen in the real world? Yeah. Yeah, you can like have money taken out of there unauthorized. You can take out, let's say you took out $50 for food, you have the ticket in there, and you come back and you're like, it only cost me 48, and you put the $2 back in, right? So the ticket still says 50, but now you have $152. So that now it equals to $202.
bills.
Yeah.
You're not always gonna have exact amount. You're gonna take 5 instead of 1.
Exactly.
But you have ticket only for $1, so it's tricky.
Yeah. Exactly. So there's a lot of room for real world situations to mess up the balance. Okay. So is the mistake always going to make the balance lower or higher, or uncertain? Depends on the mistake. What do you think? Yeah, unsure, right? I just gave you an example where the balance went up to 202, right? If I, again, made a ticket for 50, I only spent $45, and I put the $5 back in the box, right? We would have, first, it would have been $150 and $50 ticket. Then the person actually only spends 45. So they took 50 out initially, right? But now they're going to put 5 back in. So now I have $155. So I added the 5 back here. But the ticket, unless they went in and changed the ticket to 45, right? If they forgot to do that, then I'm going to have actually 205 in here. So really the correct thing would have been to take this $50 ticket, edit it, and make it 45. Then I would have been okay. But if I forgot to do that, then the balance is going to be wrong. Okay. And then an easy way to think about it being lower is if someone just came and stole money, right? Then it's like I'm going to have less money than I would have. Okay. So it could have been that I took a $50 ticket and then someone came and just took $10 out of here. Then I would have been 140 plus a $50 ticket is equal to 190. So it could be higher or lower. Okay. It depends on what the mistake or whatever the issue was. Okay. So what happens when we want to replenish and kind of actually account for the tickets? So we get to the end of the month. We go in and we physically count. We have $118 in cash. And we have $80 in tickets. So we have 2 different tickets. We have one for office supplies that we bought, and then $20 for a delivery expense. Okay? So when we add this up, 118 plus 80, we see that we're actually not at our $200. So we had something happen here. That was a mistake. Maybe someone took out $2 and forgot to make a ticket. Something happened. Okay? So for the time being, we're just going to do a journal entry to kind of account for what we do know. So we can see here we have an adjusting entry. We're going to debit office supplies, which is what? What kind of account is that? It's an asset, right? So because we bought these office supplies, we have this new asset worth $60. Delivery expense is an expense account, also debit. Cash short and over, because we need this to balance, okay? We know that to get this $118 back to $200, we need to go to the bank and get $82, right? So that's where this cash is coming from, right? Does everyone agree with that? So you start with actual how much cash you have. You know what the balance should be. You know how much you need to go to the ATM and get. You know that exact amount because you went in and you counted how much cash there was. So this is kind of clear. This is clear, and this is clear. Now to make it balance, you're going to have to use this account called cash short and over. And as the name implies, it could be short or it could be over. In this case, we were short, right? We didn't have enough. We were $2 short. So when it's short, it's going to be a debit just to make this journal entry balance. If we had too much money, right? Let's say we had, instead of $118 in cash, we had $120 or $122 in cash, right? We would have had $122 in cash, $80 in tickets. That means we would have had $202, which means we would have been $2 over. Basically, how that would have changed our journal entry, we would still have the same thing. We would have office expense or office supplies. Sorry, let's shorten that to office supplies, $60. we would have had delivery expense, 20, because those were tickets that we had filled out. The cash, though, how much cash do we need now? We had, instead of 118, right? I'm just kind of changing this. I had 122. So how much do I need to go to the ATM to get it back to 200? How much? 78, right? Right? 78 plus 122 is 200. Okay, so now what do I got to do to make this journal entry balance? Do I need a debit or a credit? I have $80 of debit and I have $78 credit. So I need $2 credit. Okay. So again, it's going to depend on the situation. If this cash shortened over is a debit or a credit. Okay. At some point, you'll have to figure out what this is because this account needs to go to zero. So let's say we found out that, hey, the cash was actually, the delivery expense was actually $22, right? So what we would do, so right now, delivery, right now it's at 20, should be 22. So that means we need to debit it $2 more. So what we would do is basically debit delivery expense $2 and cash. Okay, and this was with the original, this journal entry here, right? Where you had this debit balance. So you originally, so after you do this, this will go to 22 as we wanted. Cash shortened over. Started with the $2 debit balance. We're crediting it to. This goes to zero. Okay, because you want this cash shortened over at the end of the period. You need to figure out where that money went. Okay, so this should be zero. You need to do some work to figure it out. You have to do some investigation. But the goal is eventually to kind of fix whatever the issue was and get this to go to zero. Because right now in this journal entry, it's kind of like a placeholder. There was some mistake made. You need to fix it. Yeah.
What is the account for stolen cash?
Yeah, you would have to have some expense for that. Some shrinkage like we had for inventory. It'd be the equivalent of like administrative shrinkage. It'd be some expense though. You'd have to take a lot. It would reduce your net income by however much was stolen. Make sense? Okay, all right, so let's do a practice problem. 26A. So I think it's the second tab. You're given some information. Now, look, one thing I'll point out is that if you look on the replenishment, there's no mention of the petty cash account. We use the petty cash account up here to set it up. And after that, the balance is always going to be 200. We're just going to now replenish it using whatever expense accounts that we got to account for, and then just going and taking out more cash. We would only use the petty cash account again if we wanted to increase the balance or reduce the balance. Okay, so that's a little nuance here that's going to be relevant in this practice problem. Okay, because you're going to be asked to first set it up, account for certain expenses, and then the third part is, well, you want to increase the balance of the petty cash. Okay, so just think about how you're going to achieve that. Okay, so why don't you work on this, and we'll try to wrap it up by the end of class. So you have 20 minutes, so maybe work on it for like 10, 15 minutes, and then we'll do it together. All right. first transaction, June 1st to set it up. 7-1, whatever. Okay, so the first transaction is to debit petty cash, credit cash. Okay, so again, petty cash is this kind of sub account of cash that is representing the physical cash that we have in our office or whatever. So we're going to set it up with this journal entry. So now what we've done is we went to the ATM, we took $450 out of our bank account, and now we have it sitting somewhere in our office. Okay, so our total cash is unchanged. We've just moved it from one cash account, which is like, you can consider again, this is our bank account cash, and now we have physical cash, but the total cash globally is unchanged. Okay, so now throughout the month, the actual amount of cash is changing, right? Because we're spending it on stuff. You can see here it's numbered. And the reason why these tickets are numbered is like, let's say we had 102, 101, 102, 104, and 105. We would know that 103 is missing, right? Because we have numbered tickets. So the numbering system will help us identify missing items. Okay, it will also prevent duplication, right? We didn't have it numbered. We might have two duplicates of the same transaction, and so the numbering system is like kind of this documentation control. Okay, so basically, when I replenish, I can just kind of copy and paste these. They're all going to be debits. Okay, oops, this one is not. Okay, I know they're all going to be debits. Okay, they're either going to be the purchase of assets or the expenditure of expenses. Okay, so I know all these amounts are going to be debits. Yeah. Okay, and finally, I know how much cash I need to go to the ATM to replenish it because I have 310 in my bank or in that box. So how much do I need to go to the bank and get it back up to 450? If I have 310, want to have a total of 450 when I replenish this account, what is the math? What's 450 minus 310? 140. Okay. So I know that my bank account cash is going to get credited. I'm going to reduce the amount in my bank by $140 because I need to bring that physical cash to replenish this back up to 450. Okay. So now after this, my bank account is my impressed cash account balance is back up to 450. Now, is this journal entry valid? If I add these up, it's 145 debit, and I only have 140 credit. That means I need 5 more on the credit side to make this balance. And we're going to put that in cash, short, and over. Okay, so what does this mean? It means that I have tickets worth 145, but I only needed $140 to replenish it, which means that one of these tickets, it was like the era where maybe I took $65 out for merchandise inventory, but it only cost me $60, and I put the $5 back in. So I was over by $5. Okay? Again, if this had been exactly, if I had like 305, right? It would have exactly matched up, and I wouldn't have to have used the cash short and over. Does everyone agree with that? If I change this to 305 instead, how much would I have to go to the ATM to get? 145, right? If that was the case, I wouldn't need this because these debits sum up to 145, and this credit would have been 145. So really, theoretically, I should have had $305 in here, right? But since there is some mistake or something happened, I had more money than I should have theoretically had. Okay, everyone good with that? Understand? Okay. So I'm going to change this back. Okay, and then finally, it's saying to increase this balance to 475. So look, right now, I have in petty cash, if I go back up to the first journal entry, I have a debit $450. And what it's saying now is I want to have a balance in this of 475. So I want it to be 475. So what do I got to do to petty cash? Debit 25. Okay. So I'll debit this petty cash 25. And I'll just go to the bank and I'll get 25 more dollars. Okay, makes sense? All right, yeah, so that's it. Pretty simple. I think the only tricky part is really dealing with this cash short and over. And the way I would do it is I would start off with how much cash do I need to go to the bank to replenish it back up to the balance, and that is just based on how much physical cash I have at the end of the month. So it's an easy subtraction problem. It's the balance minus how much cash I have. That will tell me that amount of cash. I'll have the tickets. So I just put the ticket amounts, and then to plug the gap between the debits and the credits, I will use cash short and over. So just set up the two things you know for sure. The cash short and over will be what follows based on that. Okay? Okay, so on Wednesday, we will, again, I would definitely come back because it's the hardest part of this chapter, which is the bank reconciliation. So we're just going to be focusing on that. Okay? So, yeah, so that's it. See you guys on Wednesday.